Most REITs are today doing really well. Their balance sheets are the strongest they've ever been, with loan to values of right around 30 to 40%, and their debt maturities are historically long at nearly 10 years. Therefore, REITs are not heavily impacted by the surge in interest rates. However, they are greatly benefiting from the high inflation, which has led to some of the fastest rent growth in many years. As a result, REIT cash flows grew significantly in 2022 and hit new all-time highs. This fueled a lot of dividend hikes, as well as more than half of REITs increased their dividend. But this does not mean that every REIT is hiking its dividend. On the contrary, quite a few have cut recently, and I think that we'll see many more dividend cuts in 2023. But which one are they? Hey everyone, this is Yossi. I run an investment firm that specializes in REIT investing, and in today's video I'm gonna talk to you about 5 REITs that I expect to cut their dividend in 2023. But before I get into it, if you could please like this video, it will help me a lot. Thank you very much. So the first REIT that I expect to cut its dividend is called Office Properties Income Trust, ticker symbol OPI. As you can tell from the name probably, this is an office REIT. It owns mainly single-tenant office buildings, and unfortunately I think that those are the office buildings that are going to face the most pain from the growing trend of remote work. This is because they only have one tenant, and so this tenant holds a lot of bargaining power with the landlord. They know that at the time of the lease expiration, the last thing that the landlord will want is the tenant to vacate and them to be left with an empty building. And since they know this, they hold a lot of bargaining power. They're going to be able to ask for a lot of tenant improvements, a lot of capex, and this is going to cost REITs like OPI very dearly in the coming years. Today, its payout ratio may not seem that high at 66%. And yes, it's not high compared to most other REITs, but it's actually quite high for a single-tenant office REIT. And if you compare it to the payout ratio of Orion Office as an example, which is another REIT that specializes in this segment of the market, its payout ratio is below 30%. And they keep it so low because they know that lots of capex is coming their way. And I think that 66% is just going to be too much when you take this into account. It also doesn't help that this REIT is externally managed. It suffers significant conflicts of interest. And so I just don't see the point of buying this REIT. I think that the dividend cut is coming. There are conflicts of interest. It has historically been a poor performer. If you want to invest in an office REIT, you probably will be better off with a REIT like SL Green. Then the second REIT that I expect to cut its dividend is called Global Net Lease, ticker symbol GNL. Global Net Lease is quite similar to OPI, but it's a bit better diversified. It doesn't own only single-tenant office buildings, it also owns some single-tenant industrial properties, and this appears to be reassuring the market a bit because industrial properties have done quite well in recent years. But I think that what the market is overlooking here is that it still has about 40% of its assets, so nearly half of them in office buildings. And then secondly, the industrial properties that it owns aren't some of the highest quality. They are not comparable to those of a Prologis as an example. These are high cap rate, high risk industrial properties that are quite cyclical, and so if you go into a recession, I would expect them to suffer quite a bit. And then thirdly, this is also a REIT that's poorly managed. It has an external management structure. It's notoriously conflicted. They keep issuing a lot of shares at dilutive prices. I'll put a chart on the screen that shows you the share count of the company keeps on rising even as its share price goes down, a clear sign of conflicted interest. And then finally, the payout ratio is too high here at over 90%. For this asset base, it's simply not sustainable. Then the third REIT I want to discuss is called Easterly Government Properties, ticker symbol DEA. This is once again a REIT that specializes in single-tenant office properties. You can start to see a trend here. But unlike the 2 previous REITs that we discussed, this one specializes in properties that are occupied by government tenants. And this reduces risks to some extent because these tenants might be a bit more heavily tied to these specific properties. But even here, these tenants are going to hold a lot more bargaining power at the time of lease renewals because they know that there is now a lot more vacant space out there, and so they're going to be able to negotiate for lower rents, for more tenant improvements, some capex to make the properties more desirable to them. And so this is going to cost this REIT a lot of money. I'm not so certain about this one whether it's going to cut its dividend, but if I had to guess, I would say that it will. But then the fourth REIT is called Necessity Retail REIT, ticker symbol RTL. I'll keep this one simple and short. It has a conflicted management team. It has too much leverage, a high payout ratio, and its retail assets are quite cyclical. And so if you combine all of this together, you're very likely to get a dividend cut at some point in the future. Then the fifth and final REIT that I want to discuss is One Liberty Properties, ticker symbol OLP. This is a REIT that I like quite a bit. It has a good management team with a strong track record. There's a high insider ownership, so there is a good alignment of interest between managers and shareholders. So a lot of positive things to say here, but I fear that the dividend cut is coming here not because of poor management, but because of the following reasons. Firstly, this is a net lease REIT, but unlike most of the net lease REITs like Realty Income as an example, its leases are quite short at just 6 years on average, and it has quite a lot of lease maturities in the coming years. Secondly, it owns a lot of retail properties, and out of these retail properties, a lot of them are either furniture stores or office supply stores, and I think that both of these are going to struggle in the coming years because few people are buying furniture since few people are buying homes first of all, and then the office supply stores is also struggling from the growing trend of work from home. Then in addition to these retail assets, OLP also owns a lot of industrial properties, but just like global net lease, these are higher cap rate, higher risk properties that will struggle in a recession. They're quite a bit more cyclical than average. And then finally, the REIT has quite a lot of debt maturities in the coming years, and that's not going to help them in today's high interest rate environment. If the payout ratio was low, I would still feel confident that they could manage all of this, but today the payout ratio is over 90%, and so I think that the dividend cut is very likely. So these are 5 REITs that I probably wouldn't buy. They are likely to cut their dividend because of the assets they own, the over leverage, the high payout ratios, and other reasons that we discussed earlier. It's a good reminder that it's very important to be selective when investing in REITs. At High Yield Landlord, we invest in just 1 out of 10 on average. If you want to get access to my REIT portfolio, feel free to join High Yield Landlord, our REIT newsletter for a 2-week free trial. I'll put a link in the description of this video. And otherwise, please let me know your thoughts in the comment section below. And if you could again like this video, it will help me a lot. Thank you very much. See you at my next one. Bye bye.